Let's start with what you actually pay. There are 4 distinct entry points, and they share almost nothing in common except the word esports in the pitch document. Franchise slot in a major publisher-controlled league. This is the prestige product, a permanent seat at the table in League of Legends, Call of Duty, or what used to be Overwatch. When Activision Blizzard launched the Overwatch League in 2017, 12 teams paid $20 million each for inaugural franchise spots. That was the floor. Expansion slots for Season 2 were reported by ESPN sources to be priced between $30 million and $60 million depending on market. The North American LCS, Riot Games League of Legends Regional League, set franchise entry at $10 million for existing teams transitioning from the old open competition format, with new entrants paying $13 million. The Korean LCK charged a $10 million non-refundable application fee just to be evaluated for a slot. Call of Duty League team slots reportedly required more than $25 million each. These numbers do not include your operating budget, your player salaries, your facility, your staff, or your content infrastructure. These are the cover charge, and critically, they are not refundable if the party ends early. When Activision Blizzard shut down the Overwatch League at the conclusion of the 2023 season, the reported total payout to all 20 contracted teams was approximately $120 million, meaning the average team owner walking away got roughly $6 million against an original $20 million buy-in before accounting for 6 years of operating losses. Acquisition of an existing organization. This is the distressed asset market, and right now it is remarkably active. In March 2024, GameSquare Holdings completed the acquisition of FaZe Clan, 10 years of brand equity, multiple active professional rosters, 8-figure social following, for approximately $17 million in stock. FaZe had been valued at $1.2 billion at its September 2022 peak. The gap between that number and the acquisition price is not a negotiating outcome. It's a signal about what the market decided the underlying business was worth after the books were open. Mid-size organizations with real competitive histories and existing sponsor relationships trade in the $3 million to $15 million range, depending on franchise status, active contracts, and revenue trajectory. Build or buy a non-franchised regional organization. If you want a professionally registered, staffed organization competing in Tier 2 leagues, Valorant Challengers, ESL Pro League, regional CS2 circuits, you're looking at $500,000 to $3 million to acquire something functional, or to assemble one from scratch with real player contracts and a real operations team. The reserve capital requirement is the part that most people building at this tier skip, which is why most of these organizations die in year 2 when a sponsor doesn't renew and salaries are due. Startup team. You can form a competitive esports team for $50,000 to $150,000. You will have players, equipment, and a logo. You will not be in a franchised league. You will not have media rights. You will not have meaningful sponsor access. I mention this tier because an enormous amount of capital has entered this industry at this level from people who believed we're an esports organization was the same sentence regardless of which tier they were describing. Now, the gauntlet, except in esports, the gauntlet isn't a regulator. That's the problem. Traditional professional sports ownership requires league approval. The NFL process alone involves 12 to 18 months of review, financial disclosure, background checks, demonstrated operating reserves, and a vote of approval from 24 of the 32 existing team owners. The NBA standard requires similar scrutiny. These structures exist partly to protect league integrity, and partly because existing owners have strong financial incentives to ensure new entrants don't destabilize the product. Esports franchise leagues are governed entirely by game publishers. Riot Games controls League of Legends esports globally. Activision Blizzard, before Microsoft's acquisition completed in October 2023, controlled both the Overwatch League and the Call of Duty League. Valve controls Dota 2's major circuit through its partnership with ESL and PGL. These are private companies setting private contract terms. The franchise agreement you sign is a licensing arrangement, not a property right. The publisher can restructure the league, relocate teams, alter revenue sharing terms, or discontinue the competitive format. And you are entitled to exactly what your contract says, which may be less than you expected. For non-franchised organizations, the regulatory floor is even lower. There is no external body requiring minimum capital reserves for an organization calling itself a professional esports team. There is no mandatory escrow for player salaries. In most jurisdictions, there is no specific licensure required to sign professional players to contracts. You are operating in a space where the professional norms are aspirational rather than enforced, which matters considerably when you're a player trying to get paid. The Esports Player Association has existed in various forms and continues to advocate for standardized contracts and minimum salary protections. As of mid-2026, no major jurisdiction has enacted enforceable minimum standards comparable to collective bargaining agreements in traditional sports. This is a structural gap, not a temporary oversight. If you want real exposure to esports economics without franchise-level capital destruction, the more defensible entry point is the content-first model. The logic is straightforward. An esports organization's revenue comes almost entirely from being a media property, from audiences watching players compete and audiences watching players create content. The competitive result drives the narrative. The narrative drives the audience. The audience is what you sell to sponsors. So why pay for the competitive infrastructure when you can build the audience through content creation with dramatically lower fixed costs? FaZe Clan's original business, before it started paying franchise fees and signing professional contracts across 8 game titles, was essentially a YouTube channel run by people who were extraordinarily good at gaming content. That business had real margins. The expansion into professional rosters transformed what was a content company with variable costs into a sports operation with fixed liabilities, player contracts that owed money regardless of viewership, facility costs that ran regardless of tournament results. Content-first organizations, structured around signed creators and streamers under talent management deals rather than around competitive rosters, can build real sponsorship revenue with infrastructure costs in the $200, zeros into $800,000 range annually. There is no franchise fee. There is no roster buyout risk. The margin structure resembles a talent agency or a media company, not a sports franchise, which means it can actually produce one. Overactive Media, the Canadian firm that operated Madrid Lions in the Call of Duty League and held European League of Legends assets, publicly explored this model in its attempts to diversify revenue before its own restructuring. A company that understood theoretically what the content-first structure required, but was already locked into franchise obligations that made the pivot difficult. The lesson isn't that content first is easy. It's that entering at the franchise level makes it nearly impossible to pivot later. Here's the simplest possible explanation of how esports money works. Imagine you own a billboard. The billboard is a human being who plays video games in public. That human's performance generates audiences on Twitch, YouTube, and broadcast partners. Advertisers pay you to put their brand on the billboard's jersey, in the billboard's social posts, on the billboard's stream overlays, and in the billboard's pre-roll content. Your entire revenue model is an audience to advertiser arbitrage. You buy audience time through salaries and operational infrastructure, and you sell attention to brands. At the small end, a regional organization with 50,000 average monthly viewers across platforms might command $180,000 to $350,000 per year in sponsorship agreements, against annual operating costs of $800,000 to $1.2 million for a real roster and professional staff. That's a gap you cover with investor capital, merchandise revenue that rarely materializes at the projected scale, or by not paying your players, which is increasingly documented as an industry-wide practice rather than an isolated anomaly. At the institutional end, Team Liquid, one of the most consistently well-managed franchised organizations in esports history, reportedly generated $50 million in revenue in 2022 across its multi-game operation. Team Liquid competes in League of Legends, CS2, Dota 2, Rainbow Six Siege, Valorant, and multiple other titles simultaneously. Its primary sponsors have included SAP, Honda, and Monster Energy. It spent 15 years building the sponsor relationships, performance track record, and operational infrastructure that justifies those numbers. You are not replicating that in a 3-year investment horizon. The revenue breakdown across the industry per market research, sponsorships account for roughly 55 to 65% of total esports revenue. Media rights contribute the next largest segment. The market research firm Newzoo estimated the global media rights segment at approximately $192 million as of recent data. Merchandise, content licensing, and direct fan revenue fill the remainder. Prize money, the thing most outside investors think is the primary revenue driver, typically represents less than 5% of an organization's total annual revenue, and players contractually retain most of it anyway. There is one more number worth stating plainly. Riot Games, the publisher behind League of Legends, reported revenues of approximately 1.85 billion euros in 2024. Its European league, the LEC, one of the 3 most watched regional leagues in the world, operating in one of the most valuable advertising markets in the world, recorded a loss of 18 million euros in 2024 alone, with accumulated losses exceeding 71 million euros as an entity. This is the best case scenario. A healthy game, a major market, a well-produced broadcast product, and the league still loses money. Now, the 2 case studies that explain why the math plays out the way it does. The first case is about a company with too much money and a cost structure designed to spend it. FaZe Clan was founded in 2010 as a Call of Duty trick shot YouTube collective. For its first several years, it was a content operation, no franchise fees, no professional rosters, just a brand built on genuinely elite gaming content with a cultural crossover appeal that no traditional sports property had managed. By the late 2010s, it was signing players across professional titles, signing rappers and athletes as members, and positioning itself as the defining brand at the intersection of gaming and youth culture. CEO Lee Trink, who joined in 2018 from the music industry, pushed the company toward institutional capital and an eventual public offering. On July 19, 2022, FaZe Clan went public on the NASDAQ through a SPAC merger at a $725 million valuation. The stock fell 24% on the first day of trading. Within months, shares were trading below $0.20, a 98.6% decline from the IPO price of $13.07. Lee Trink was ousted by the board. The financial results made the problem visible. FaZe reported an operating loss of $48.7 million in 2022. Q1 2023, a $7.7 million operating loss. Q2 2023, $28 million in operating losses, roughly double the same quarter the prior year. Revenue was real. The cost structure was incompatible with any margin that made the revenue meaningful. The SPAC structure had allowed FaZe to bypass the financial due diligence requirements of a traditional IPO. Forward-looking projections used to justify the $725 million valuation were characterized as aspirational forecasts, legally defensible, commercially fictitious. No criminal charges related to securities fraud were filed. SPACs are designed in a way that makes the gap between projected and actual performance a business disappointment rather than a legal violation. This is worth knowing before you rely on any esports organization's investor materials. On October 20, 2023, GameSquare Holdings announced a definitive agreement to acquire FaZe Clan for approximately $17 million in stock. The deal closed March 8, 2024, 18 months from $725 million to $17 million. The founder members who had built the brand over a decade had been diluted to fractional relevance. Every investor who bought in at or above the SPAC price lost essentially everything. The second case study runs in the opposite direction. Not too much money, a company that had already ceased to legally exist. Bleed Esports was positioned, publicly and credibly, as Singapore's leading professional esports organization. It ran competitive teams in Counter-Strike 2, Valorant, Dota 2, and Rainbow Six Siege, multi-game, multi-region, internationally active. It competed in events sanctioned by Riot Games. Other organizations transferred players to it and received transfer fees as part of standard player movement contracts. Sponsors associated with it, tournament organizers credentialed it. In September 2023, Singapore's Accounting and Corporate Regulatory Authority, ACRA, deregistered Bleed Esports as a legal entity. The company as a registered corporate structure ceased to exist. It continued operating, competing, signing players, and accepting transfer fees for 13 more months. In October 2024, former head coach Alexander Kasad Trifunovic published a detailed accounting of what had actually been happening. Kasad, a respected CS2 coach with previous stints at G2 Esports and Apex, had joined Bleed believing he was contracting with a legitimate business. He documented that the organization owed more than $300,000 across players, staff, and transfer fee obligations, including fees owed directly to G2 Esports and Apex, for the player transfers those organizations had completed in good faith. He had personally financed boot camps because Bleed could not. Players had gone 4 months without pay. Rainbow Six Siege player Turdsta disclosed he had not received more than $35,000 owed to him on a monthly salary of less than $700. The former CS2 roster competed in the RES Regional Champions Tournament and the Thunderpick World Championship 2024 under the team name UNPAD. Not as a protest, as a description. CEO Go In Wei Mervin faced a criminal hearing in Singapore, scheduled for October 21, 2024. No widely confirmed final verdict has been reported as of this script's research date. The ACRA deregistration had been a public record since September 2023. It was findable. No tournament organizer, no game publisher's credentialing process, and no organization completing player transfers into Bleed appears to have checked it before the publication of Kasad's post 13 months later. 4 rules from these 2 case studies. Rule 1. Verify corporate registration for every organization you acquire, partner with, or transfer players to. Deregistration is a public record in every major jurisdiction. It takes approximately 4 minutes to check. No one checked Bleed's status for over a year. Rule 2. Franchise fees are sunk costs from the moment of payment. The Overwatch League's $20 million entry fee did not include guaranteed revenue floors, protection against publisher restructuring, or contractual security against league discontinuation. What it included was exactly what the agreement said, and when the publisher decided to wind down the league, the maximum return for most owners was $6 million. Model every franchise-level investment assuming 0 terminal value. Rule 3. Consolidate your revenue reporting by segment, or your cost structure will hide the loss. FaZe's content business was functional. Its professional roster business was incinerating cash. Reporting them together allowed the P&L to look coherent enough to go public. Separate your media business accounting from your competitive roster accounting from day one, because they have completely different margin profiles and completely different risk exposures. Rule 4. Player contracts are fixed liabilities. Sponsorships are variable revenue. When audience drops due to a game losing relevance, a scandal, a creator departure, or a competitor, sponsorship revenue adjusts immediately. Player contracts do not. This timing mismatch is the mechanism that ends most esports organizations. It is not a risk. It is the standard operating condition of the industry. The single largest structural threat to this business model is not a bad sponsor cycle or a management failure. It is game lifecycle dependency. Every esports organization in a franchise single-title league is making one central bet: that its primary game remains culturally relevant and commercially dominant for long enough to produce a return on the franchise investment. Game relevance is not controllable. It is not hedgeable through operational excellence. It is determined by the publisher's product decisions, the competitive gaming landscape, and the attention of an audience demographic whose preferences shift faster than most asset classes. The Overwatch League's collapse illustrates this at scale. Overwatch 2 launched in October 2022 as a free-to-play replacement for Overwatch 1, intended to revitalize the game's competitive audience. The launch did not produce the viewership recovery Blizzard required. A gender discrimination lawsuit against Activision Blizzard, settled for $54 million with the California Civil Rights Department in 2023, had already pushed major sponsors to withdraw. The combination of declining viewership, sponsor pullback, and a game that had not recaptured its peak audience created conditions where continuing the league was economically indefensible for the publisher. By the end of 2023, it was over. Total capital raised through franchise fees across the league's existence, more than $500 million. Total return to team owners, approximately $120 million. League of Legends has been the most watched PC esport for over a decade. It is the strongest possible game to base a franchise around. Its European Regional League, the LEC, still lost 18 million hours in 2024 and has accumulated more than 71 million hours in losses as an entity. The structural fragility is not specific to bad publishers or bad games. It is specific to the business model. Grandview Research Project's global esports market size at $3.3 billion in 2026, growing to $12 billion by 2033 at a compound annual growth rate of 20.4%. If that growth materializes and concentrates in the top organizations across the top titles, the best positioned operators will eventually profit at institutional scale. The question isn't whether the market grows. The question is whether your specific asset is in the organizations that capture that growth, or whether it's in a franchised league that doesn't exist in 2030. Time to pull it all together and answer the actual question. How much money do you actually make if you do this right? Tier 2 regional organization realistic case. You build or acquire a professionally structured organization competing across 2 game titles in non-franchised leagues. Total initial capital deployment, $1 million, covering acquisition or build costs, player contracts across 2 5-person rosters, initial staff hiring, infrastructure, and 6 months of operating reserve. Annual operating costs, approximately $1.1 million. Player salaries at a realistic regional rate across 2 rosters, $420,000. Support staff, 2 coaches, 2 analysts, a social media and content manager, an operations director, and a part-time finance function, at approximately $280,000. Housing, travel, and boot camp costs, $150,000. Content production and brand marketing, $120,000. Legal, administrative, and accounting, $130,000. Annual revenue, optimistic case, $650,000 to $800. A 2-title regional org with tournament results and a consistent content presence can attract 2 to 4 mid-market sponsors in the $150,000 to $250,000 range each. Merchandise and direct fan revenue add $50,000 to $100,000 in realistic projections. Prize money, after player shares, is unlikely to contribute more than $30,000 annually. Annual net, negative $300. 0C to negative $500,000. You are not building a profitable business in year 1, year 2, or year 3 at this tier. You are building a portfolio of sponsor relationships and competitive track record that might, in year 4 or 5, close the gap. Most regional organizations don't reach year 4. Tier 1 franchise league slot, best available case. You acquire a franchised LCS slot. Call it $10 million entry cost with a $6 million operating budget for year 1. You have genuine media rights revenue, access to Riot Games' revenue sharing pool, and a legitimate platform for institutional sponsorship conversations. Annual operating costs at LCS competitive level, $5 to $7 million. 5 players at LCS average base salaries of $410,000 each. $2.05 million. Coaching staff, analysts, performance coaches, $800,000. Content team, brand team, operations, $900,000. Facility, travel, equipment, $600,000. Administrative overhead and legal, $500,000. That's $4.85 million before you've accounted for player buyout costs when roster moves are required. Annual revenue, top quartile franchised case, $7 to $12 million, with strong sponsor relationships and consistent on-stage performance. This is not the median outcome. This is what you're working toward in year 5. Net, on that trajectory, break-even to modest profit in the $500,000 to $2 million range, beginning in year 5 or 6, against a $10 million franchise fee and $25 to $35 million in cumulative operating costs to reach that point. The IRR on that capital, accounting for the real probability that the league restructures or the game loses relevance before year 8, is negative in expected value for the majority of entrants. The math works if you treat this as a media company acquisition, if the audience you're buying is worth more than the infrastructure cost to maintain it. It does not work if you treat this as a sports franchise and wait for the broadcast deal to save you. There is no broadcast deal structured to save you. You wanted to buy a professional esports organization. You still can. The assets are historically cheap right now. FaZe Clan, with more brand recognition than most sports franchises built in the last 30 years, sold for less than a single Manhattan apartment building. The entry was never the hard part. The hard part is what comes 3 years later, when the publisher decides the league format needs to change, your roster's primary game starts losing viewers to something new, and you discover that the team name Yunpei was not a warning that arrived before it was relevant. It was already the operating reality of the organization next to yours for 13 months, while everyone treated them as legitimate. Whether that makes this industry an opportunity or a trap depends entirely on which side of the ledger you're positioned on. That's the question we don't answer for you here. If you want to watch what comes next before it happens, not after, subscribe. We find these structures before the collapse.